In this edition of How We Invest Your Money, I'm speaking with Bianca Rose from Morningstar Investment Management about global property and infrastructure, including why she feels they're largely overvalued at the moment. Bianca, thanks for your time today.
Thanks, Glenn. I'm glad to be here.
So Bianca, how does Morningstar Investment Management get exposure to real estate within its portfolio?
Yeah, so we have our global REITs portfolio, so our global real estate portfolio, and we tend to focus on real estate investment trusts as opposed to property developers. So what we're looking for there is we look at developed markets, so whether it be in Europe, Asia, the US and Australia inclusive, and we will invest in a range of commercial property stocks, so that being office stocks, retail property and also industrial REITs is predominantly our focus. So in terms of the types of stocks that we're looking for predominantly rental earnings, so not so much funds management earnings in property, also not so much property development profits. We're also looking for lowly leveraged real estate stocks, because we think that if you're too highly leveraged, you can get into a little bit of trouble, and particularly if the interest rate cycle turns. So we just try to keep it really simple and try to get what we think is the purest rental property return, because we think that's diversifying to the other assets held in the portfolio, namely the equity growth assets.
In terms of real estate investment trusts or REITs, what's your view overall on that asset class?
Yeah, so at the moment we have a low conviction on the asset class, so we are underweight the asset class. We do think it has diversification benefits, but we think the valuations are a little bit expensive at this juncture, just with where the interest rate cycle is at. So they are an income-focused asset class, and in this current low interest rate environment, people have been chasing property, if you like, to get that higher yield. And we think the valuations are a little bit on the rich side, so we think there is some downside potential. So at the moment, we do have a exposure to it for diversification benefits, but it is a lower exposure than we would probably normally have in other environments.
You mentioned there about the interest rate movements and how that plays into your decision making. So can you just elaborate for us there?
Yeah, so we don't try to predict where interest rates will go in the short term, but we look at the basis of where probabilities and valuations are at today. So when we look at valuations for property, and we're looking specifically at cap rates, and what are cap rates? They are discount rates for those rental streams. They are at very historical lows, so those discount rates means that the valuations are on the high side, if you like. So those discount rates are very low because interest rates are low. It did earlier this year get a little bit more attractive in property as those interest rate expectations particularly in the US, for the US Fed raising rates kind of started to get priced into listed property. And we saw valuations come a little bit more attractive, but unfortunately they're just not really attractive versus where we think the kind of long-term fair value is.
How do you guys think about infrastructure? Is it you also look at the listed infrastructure side of things, or do you go for utilities or for transport?
Yeah, so when we're looking at infrastructure, again, we approach it a similar way to how we approach property. We're looking for diversification benefits, and we're looking for diversification benefits primarily versus your growth equity asset class. So within infrastructure, there's kind of, I guess, two kind of main spheres of types of infrastructure. One where we would call the more economically sensitive area, which would be your toll roads, your airports, your ports and railroads, which the traffic volumes and so on those types of assets are more subject to economic growth. So when you go to the airport, if it's good times, you're probably more likely to travel. And then the other side to the infrastructure universe would be the regulated utilities, where pretty much the government will set what kind of return you can earn. And it is primarily, I guess, just an income yielding, and there's not much upside, there's not much downside other than where the valuation might be at. So our approach to infrastructure has been to favour more regulated assets. We think that gives you more of a diversification sort of profile, but we're also consider that the toll roads and the airports, depending on where valuations are at. At this point in the juncture, much like property, we think that the valuations are a little bit rich. So we're not heavily exposed to that area, but we do think there's time and place to be more exposed to these areas.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.